To today's action now with our market panel, Barbara Doran of BD8 Capital Partners and David Kelly of JPMorgan Asset Management. Welcome, both of you. David, we've got one more trading day before the jobs report. You're still expecting 3 cuts this year. Not everybody at the Fed is. So how important is that report? What are you looking for sort of in the hours ahead of it as we see the major indices sort of treading water here?
Well, I think it is important that we get 3 rate cuts. The futures market is nervously still pricing in 3 rate cuts this year and pricing in a first cut in June. But it's close. I mean, you can hear voices on the Fed saying, why do we need to do it now? Why do we wait? And my response to that is, look, the economy is in pretty good shape here. Inflation's coming down slowly but steadily, and it's not that high right now. So if the economy is basically where you want it to be, why do you have an inappropriate level of monetary tightening? So I think they ought to do it. I think Jay Powell wants to do it. But I think it's going to be really difficult for him to strong arm all the members into agreeing to a rate cut in June. So I expect we'll get some dissent then. So it'll be interesting. But I do think it's important for the market that the Federal Reserve get to the business of bringing rates back down to more normal levels, given that the economy seems to be pretty well balanced here.
Okay, Barbara, we've been kind of chopping sideways for the last couple of weeks. What gets us, moving in one direction or the other?
Well, the market, as we know, has had a huge run this year. S&P up 10%, up 25% since last October. So it's either the Fed cuts rates, and we've talked about that, and I think, David's right. There's, some question about whether it's going to be 3 or 2, but, the rates cuts will come, or the other one is earnings. And I think it's where the focus is on earnings. You've certainly seen since the beginning of the year when expectations were for 6 to 7 cuts, the market has absorbed the reality that at most it'll likely be 3 and could even be 2. And so I think that earnings season starts next week again with the big banks, JPMorgan, Citi, Wells Fargo. And then after that, and we're going to hear a lot about earnings and company guidance and that, because the fourth quarter was actually pretty strong. Guidance was mixed depending on the sector. But right now, the earnings estimate, the S&P average on the street is about 9 to 10%. So we'll see how this earnings does. But I think that could kick us off again.
Okay. It's interesting, David, because we did see the 10-year Treasury yield touch levels that it hasn't been at since November of last year. And it almost feels like there's a divergence between equities and the bond market right now. Treasuries, at least earlier in the day, responding to a hot ADP jobs report, also arguably that downbeat update that we saw from Ulta, whereas equities have been responding to this cooler services ISM. In terms of what's being priced into the market and where it goes from here, I just want to play this soundbite from David Einhorn of Greenlight Capital, who was on CNBC earlier today, and get your thoughts.
How many times are they going to cut this year?
I think fewer than are priced in right now.
So fewer than 3?
Sure.
You think they cut? Do you think there's a chance they don't do anything?
There's a chance. I think inflation is reaccelerating. I think there's a lot of indication of that.
So if inflation is reaccelerating, I mean, how is the equity market positioned for this, for the possibility of no cuts at all this year? Because we've started to hear, I realize it's still maybe somewhat of a long shot and it's going to be data dependent, but we've been hearing more possibility for more folks that are tied into the Fed about this in the last couple of days.
I just fundamentally disagree with that. I think inflation is coming down. It's just cooling slowly at this point. But it's already below 3%. The core consumption deflator, which is the number the Federal Reserve looks at the most, is about 2.8% year over year. I believe that'll be down to about 2.6% year over year for the April read, and that's the last read they have going into that June meeting. So it's just coming down slowly. But if you dig into the components of inflation here, really inflation is being supported by very strong growth still in shelter costs year over year and in auto insurance, and both of those are smooth or overly smooth. They're very lagging indicators. We know that both of those things should continue to come down. At least the shelter part should continue to come down, and auto insurance should begin to come down in the months ahead. So I feel pretty good about the idea that underlying inflation is going to come down. One thing we're going to be watching for on Friday is I think that the year-over-year number on wages will go from about 4.3% year-over-year to 4.1%. Proving yet again that you can run this economy at very high levels of labor force participation and low levels of unemployment. You can do that and still bring wage growth down. So this is not an inflationary economy, and the Federal Reserve doesn't need to fight a war that's already been won.